Person after person we talk to says if you want to worry about global growth, even U.S. economic growth, take a look at China. How important is it?
It's very important, no question about it. I mean, and particularly if you look at the impact to confidence, the equity markets, and then, of course, the soft patch that we're in this quarter right now. All of that is feed through from the effects that China felt from the trade war, which really started about a year ago. No question.
So, JP Morgan had a note out that basically said this was all part and parcel of embracing more risk. They say since risky assets tend to price in forward-looking fundamentals, we believe markets are likely to look through the soft patch and increasingly price in the second half year growth rebound. Resolution China trade deal, standing pat, central banks, etc. You agree?
We do. What's very interesting is, of course, there's always this element of, wondering whether Chinese economic data is what it's purported to be. There's an element of opacity. But if you look at it, right, what's gone on in China the last year is really much sort of a Western-style recession progression. Stock market tops a year ago. You start to see stimulus measures announced sort of late third quarter, fourth quarter. Presumably, you're at an economic trough. Obviously, the data has been very poor the last several weeks. And then all of a sudden, the stock market begins to rally, discounting what's going to be 12 months from now. But
but here's what I don't understand. How is a 2.62% on the 10-year conducive to a rally in global cyclical stocks, growth stocks?
That is the conundrum. And what we would say there is we have to look at the other place of risk, which is Europe. And there's no question about the fact that in our mind, in isolation, if you were only talking about the U.S. and the potential to resolve problems with China, which we do think will happen in the fullness of 2019, but the fact is that European yields are 8 basis points right now on the German 10-year, and that's what's holding us down.
Can you get to 3,000 in the S&P with the 10-year below 2.5? And one way to put it, because I mean, look, the bond market's saying one thing about the stock market's saying another thing about the stock market. Which is going to be right?
Well, in our view, the path to normalization, the path to a glide path of economic growth in the sort of call it the Fed's numbers 2.3, economic consensus is 2.5. That's not where the 10-year yield is 2.5. In our view, 3,000 is achieved with a 10-year yield that's moving back toward 3%.
So when you're taking a look at the individual sectors, how much exposure do you want to Europe? How much exposure do you want to China? How do you play that?
Well, the thing is now is that, and particularly if you think about it within the context of the sell-off in the fourth quarter, is that basically this whole idea of exposure to Europe and China comes through exposure to U.S. cyclicals, energy, industrials, and financials. So we're comfortable, looking at those areas.